about the webinar. All right, so let's talk about current market conditions before we talk about trading system. All right, so where the market currently is and where the market is heading and current market conditions. Let's talk about QQQ. You can see we had an FOMC decision hinting that interest rates might be lowered by the end of the year. Today, unemployment numbers were negative surprise. As a result, everybody is anticipating, reconfirming the view that the interest rate might potentially lowered on that optimism, and potentially from the oversold conditions that we've had. QQQ sold off from 191 to 170. That's 20 points. That's over 10% correction, 12-13% correction. We're about 50% retracement between 192 and 170, and above 200-day moving average, which is positive for market bulls, still below the 50-day moving average, but nonetheless, on the market is rebounding based on that news. Spiders is outperforming technology sector. Potentially, you can see the rotation out of the technology sector as we are approaching probably on its way to 52-week high. Market as Spiders is above 50-day moving average, outperforming the technology, boosted by defensive sectors such as utility sector and consumer staples sector. So we clearly see that technology is above 50-day moving average. As long as we stay above 50-day moving average, this is a positive news for the bulls. Short term, I think there's overhead resistance around, I would say around 290 level. That's the psychological level. As long as the market stays above 50-day moving average, I think it's a positive for the bulls. If we break 290 level, market will probably retrace to 52-week high, potentially reach 300, 3,000 on SPX level. I don't think there is a lot of momentum beyond 3,000. We are approaching earnings season. That could potentially be a positive stimulus. There is still uncertainty about the tariff negotiations with the United States and Mexico. So I think that will keep a cap on how far the rally can go. So I think if we break 290 level, best case scenario, we retrace to 295. If we break 290 level, I think best case scenario 296 300 level on the S&P. This has been a pretty considerable sell-off, so I think this is probably one of the last legs to the upside in the market. I would consider not chasing the market at 3,000 level to 98 level, but consider going short where during summer or potentially first quarter of by the end of the year, either third quarter of 2018 or fourth quarter of 2018, we potentially have another leg to the downside. And if we don't, there's not a lot of support at 272, so potentially retracing back to the 264 level or even 240 level with all the uncertainty that we have with China and US negotiation. That doesn't seem like there is a short-term solution. So that's my take on the spiders. Again, last stage of the bull market. As long as utilities and consumer staples are still leading the market, we are in the last stage of a bull market. I've been saying that for quite some time, but nonetheless, let me switch to the watch list. So utilities are at making new highs. That supports the market. Consumer staples are making new highs. That's supporting the S&P. That's the reason why QQQ is underperforming the spiders. Let's see what else we have. Volatility back to 14-15 level. Again, I think as long as US-China negotiation, there's still uncertainty. We're going to probably stay above 14-12 level. So this is potentially a good opportunity to hedge your portfolio, especially as we approach in 3,000 level. One way to hedge your portfolio, as we said before, was to buy VXX ETF or VIX calls. All of those VIX and VXX are highly correlated ETFs. You can see similar price action. What else is important? Treasuries are important. We've seen an ECB decision to maintain interest rates low, and potentially on the consensus that, or expectation that interest rates will be lowered. Treasuries are continue its upward momentum. They are overbought. We are approaching 131, 134 level. That also can potentially keep a cap on the market rally, as long as the treasuries rally. Usually they're inversely correlated. Right now you can clearly see that their treasury prices and stock market is going in the same direction. So that's one of the outliers that kind of irregular correlation. A lot of it has to do with, again, utilities, consumer staples, and the utilities sector, and also healthcare. Right, healthcare sector is also above 50-day moving average and outperforming the market. What else is interesting? Gold. Gold continues its rally. We're approaching 128 level, which is short-term overbought. I think similar picture with gold miners. Materials have been a strong leader of the market rally on relatively weak dollar. We have consumer staples rally, emerging market rebounding, Germany rebounding, China slowly rebounding, looked like it found the bottom. Euro rebounding, so short-term weak US dollar, but I think this is also a short-term rebound, and we do have a lot of overhead resistance at 110 and 112 level. Marijuana stocks, this has been a question. We can see clearly a big sell-off since March. We reached the 40 level, dropped to 30 level, so about 25% retracement, and now we're rebounding back. This is a weekly chart. If you do a daily chart, you can see underperforming the market. Same thing, I think. Let's see, biotech. Biotech is underperforming, small cap biotech. Russell 2000 is underperforming the market. So these are indications that this rally, I think, is short-lived. I don't think there's a lot of momentum for beyond the 3,000 level in SPX, as I said. Consumer discretionary underperforming the market, most likely because of the Amazon. So we can see below the 50-day moving average. Talk about small cap biotech stocks, and Dow Jones is right above 50-day moving average again. Staying, there's a lot of overhead resistance around 262 level, 260 level. All right, we'll talk about individual stocks. Angelique, good morning. XLU, I think, is over